These three things will push gold to $2,500 in 2024. In 2023, gold encountered challenges due to the strong dollar and rising interest rates. However, as expectations grew for the Federal Reserve to conclude its battle against inflation, gold's value increased notably in the last quarter of the year. The price of gold reached a new peak in early December and surpassed $2,125 per ounce. It is currently still above $2,000 per ounce. This positions gold for potentially reaching new heights in 2024. This marks gold's most successful year since 2020, achieving a 13% gain. Saxo Bank's Ola Hansen told Reuters that after a surprisingly robust performance in 2023, gold will be boosted by a trifecta of momentum-chasing hedge funds, central banks continuing to buy physical gold at a firm pace, and, not least, renewed demand from ETF investors. The demand factor. Delving further into Hansen's analysis, let's begin with the role of central banks in the gold market. Last year, central banks around the world significantly increased their gold reserves, and there's no indication that their interest in gold will diminish anytime soon. In the first 3 quarters of 2023, central banks globally acquired a net total of 800 tons of gold. This was a 14% increase from the same period in 2022, which itself set a record since 1950. The trend of central banks purchasing gold is expected to continue. The 2023 Central Bank Gold Reserve Survey conducted by the World Gold Council revealed that 24% of central banks plan to increase their gold reserves in the next year. Additionally, 71% expect a rise in global gold reserves over the next 12 months, a 10-point jump from 2022. With the recent surge in gold prices, it's likely that more gold will be invested in ETFs in the near future, which would further stimulate global demand for gold. Hansen suggests that the rise in gold prices, along with expectations of lower interest rates, may attract institutional investors back to gold. The Fed factor. The primary driver of the precious metal market is the monetary policy of the Federal Reserve. Gold's rally began as market participants started to expect the Fed to stop raising rates and shift towards reducing them. At the December FOMC meeting, the Fed met these expectations, though it didn't change its policy. Instead, it indicated through its dot plots the likelihood of 3 rate cuts in 2024 and 4 in 2025, potentially lowering rates to between 2 and 2.5%. Many view this as a sign of overcoming inflation, but a more accurate description would be capitulation. Inflation continues to exceed the Fed's 2% target significantly. Even Federal Reserve Chairman Jerome Powell acknowledged the inflation is still a concern. Inflation has decreased from its peak levels, and this reduction hasn't led to a substantial rise in unemployment, which is positive. However, inflation remains high and its future trajectory is uncertain. FOMC members seem to understand that an economy heavily reliant on borrowing cannot sustain itself in a high interest rate environment. The central bank appears to be withdrawing from its inflation fighting stance, hoping its efforts so far are sufficient to control inflation without harming the economy. This optimism may be misplaced. Despite the Federal Reserve raising rates from 0 to 5.5%, financial conditions are not as restrictive as they appear. The Chicago Fed's Financial Conditions Index as of December 22nd was at negative 0.54, indicating relatively loose financial conditions. Thus, while the Fed has tightened conditions, it hasn't done so to the extent necessary to effectively control inflation. By shifting to rate cuts, the Fed is essentially reverting to the policies that initially fueled inflation. The prevailing view is that the Fed has successfully managed the inflation issue without damaging the economy, allowing a return to more lenient monetary policies. Many believe that there won't be a recession and optimistic times lie ahead. Rate cuts are imminent and the Fed might resume quantitative easing, but not as a victory over inflation. More likely, it will be an attempt to support an economy struggling under the impact of high interest rates and burgeoning debt. Regardless of the Fed's rationale for rate cuts, whether it's a perceived triumph over inflation or an effort to combat a deep recession, such moves are likely to be favorable for gold. Gold has performed well this year despite several challenges: a strong dollar, the belief that persistently high interest rates are detrimental to gold, and general market headwinds. If gold managed to thrive in a rate hiking environment, its prospects could be even brighter in a scenario of falling rates, especially if this coincides with a resurgence in inflation. The January factor. Gold is entering the new year with significant momentum, and historically, January has been a favorable month for it. Analysis by the World Gold Council shows that since 1971, gold's average return in January has been 1.79%, nearly triple its long-term monthly average. During this period, gold has experienced positive returns in January nearly 60% of the time. Since 2000, this figure increased to 70% of January's, showing gains. The World Gold Council identifies three key factors that might enhance gold's performance in January: portfolio rebalancing at the start of the year, seasonal declines in real yields, and increased gold demand in East Asia prior to the Lunar New Year. However, past trends are not absolute predictors of future outcomes, and there have been exceptions such as the negative returns in January 2021 and 2022. Looking ahead to 2024, the circumstances seem favorable for another strong January of gold. Several factors contribute to this outlook. The Federal Reserve's rate hikes are paused with widespread expectations of rate reductions this year. This could weaken the dollar, removing a significant barrier that gold faced for much of 2023. And the latter half of 2023 saw a resurgence in the Chinese gold market, potentially indicating increased demand leading up to the Chinese New Year. Combining these factors, the demand dynamics, the Federal Reserve's policy reduction, and the historical January trend, gives us three solid reasons to be optimistic about gold as we step into the new year. The best time to invest in gold. Now is the best time to invest in gold. Gold is way underpriced as it is. But more importantly, the economic and geopolitical instability will further devalue the dollar and put our economy in distress. You would need a hedge, and nothing has beaten gold in that category. Its inverse relation to the market and cash will give you the peace of mind that you will have the asset that can carry you and your family while you wait for other assets to recover. Invest in gold now.